Hello, everybody. I know you're like me, and we're wondering what is going on with mortgage rates and what is needed for them to go down, down, down. Well, there's some factors that we have to take into play, which is the 10-year treasury, decrease inflation, weakening economy, and the cost of money. What does that mean? Well, right now, the 10-year treasury is at 4.412 as of 4 p.m. Eastern Standard Time. Usually you can add 2 plus percent, and that can kind of give you a guess of what the interest rates are. But remember, different types of loan, conventional, FHA, VA, how much money are you putting down, what's your credit scores, all of that are factors in regards to what interest rate you may get. Okay. Now, the Feds wants inflation to be at 2%. Well, guess what? We're getting close, but not close enough, right? So right now, the core inflation was 2.4, and the consumer price index was at 2.8 in March, which is down from 3.1% in February. So the Feds are like, yo, listen, I would love to cut the rates, but we need to look at these factors before we do that because we don't want to cut the rate and then inflation goes back up. But at the end of the day, I'm like you. If you can cut it, cut it. But the other factor we have to take into account is the weakening economy. So I know you've been hearing about a recession, right? So JP Morgan is expecting a 60% chance of that happening. So what does that mean? Remember, recession is 2 quarters in a row, right? April, May, June, July, August, September, that GDP is in the negative. So although we want rates to go down, it's a very delicate balance that the Feds have to contend with. But JP Morgan does believe that come September, we may get some cuts. We may get some cuts sooner. Just this is a very interesting market that we're in. Okay. Now, how about the cost of money? Well, the Fed rate today is 4.25 to 4.5. You remember when it was zero? Well, when it was zero, rates were in the twos, then the threes, then the fours, then the fives, and now they're in the sixes and the sevens. So, what's the cost of money? Well, right now it costs a bank 4.2 to 4.5 to borrow money, which means they have to add, right, 2 plus for whatever they need to do to then give us the mortgage rates that we have. So back then, remember the Feds were buying mortgage-backed securities. They're no longer doing that. Okay, so now when we're looking at these things, yes, can they start doing it? But we're in a deficit. So again, the Feds have to make that decision on, hey, how do we manage this to make sure that we're doing right by the people, but most importantly, keeping our economy safe. And if you have any questions or concerns, feel free to give me a call. I look forward to talking to you.